Well, good afternoon, everybody. I'm Wayne Miller, the Executive Director of the Venture Center. Welcome to our run of show here today for conversations as it relates to the paycheck protection issue in the PPP and the Flexibility Act and all the things that are associated with that. This has been a topic that has been on the top of our minds here at the Venture Center as we have looked at it as it relates from a bank's perspective. And we're going to get an interesting perspective today from our sponsors today, from obviously Wright, Lindsey, Jennings from Cal, and Fred, who I'll ask to introduce themselves. Also from Meador from Simmons Bank, who is our close banking partner here, and also Jason from Frost. This has been an area we focus primarily looking at it from the bank's perspective. So this is sort of a juxtaposition for us at the Venture Center, looking at it from really for our community's perspective and from the business's perspective and the issues that are affecting each and every one of the businesses who have participated here. And I see some familiar faces, Lou McAllister and a couple of others who I know have been recipients of the PPP funding and are, I know, closely watching the regulatory changes, which, as we all know, and I'm sure you guys will speak to, are really changing almost daily. So I want to again thank Wright, Lindsey, Jennings, obviously Frost, and the Little Rock Chamber for your continued support of the Venture Center. As you folks know, we are a 501c3 nonprofit, so those things matter to us and enables us to do what we hope is the good work we're doing in keeping this content active within our community as it relates to this extraordinary time that we're all living in. So with that being said, let me start with Cal and Fred. Cal, if you want to just kick us off with just a quick intro of who you are, and then we'll go to Fred and then to Itzel and then finish up with Jason, and then I'll start into the questions.
Yeah, I'm Fred Perkins with Wright, Lindsey, and Jennings, and I run our business team, one of 4 practices at Wright, Lindsey, which encompasses M&A, banking, anything transactional, really. And Cal and I have been studying the act as it came out, and kind of felt like we went back to law school for 3 weeks trying to figure out all the rules, and have been in online classes ever since, including up till this morning when the new rules came out and new guidance came out. So we'll give you our best shot at interpreting what came out overnight and this morning.
Thanks, Fred. Cal, on to you.
Yep, my name's Cal Rose. Working on our Wright, Lindsey, Jennings Rogers office. Kind of run our business practice up here in Northwest Arkansas. Fred and I work together with our Little Rock office a lot. Happy to be here. My practice is very, very similar to Fred's. Do a lot of startup work, banking work, real estate, transactional, across the board. As long as we're not in court, I can handle most of it. So happy to be here. And as Fred said, a lot has changed just in the last 24 hours, and we're excited to answer everybody's questions.
Awesome. Thanks very much. Itzel?
Hi, I'm Itzel Meador. I work for Simmons Bank. I'm the SBA sales manager. I handle all SBA production for our entire footprint, but I'm also a manager for our sales staff. So I know SBA back and forth since I've been doing SBA lending for 20 years, but I will say that the PPP program hijacked SBA. It's not your typical SBA in the way that we normally look at SBA. So I have also been working in the dark under a program that doesn't exist and trying to interpret regulation that typically I would fall back with SBA, but this isn't falling back in the typical SBA terms and conditions. So it's a new hybrid for sure for us, but we're glad to be able to be a part of it to help the community. And I'm excited to be here, and hopefully I can help answer some questions.
And so just statistically, how many loans did Simmons done? You know offhand?
Approximately 7,000.
That's fantastic. And from a revenue perspective or number of dollars, what does that equate to?
We've gotten over $1 billion out.
Awesome. Good deal. Awesome. Jason, let's finish up with you, and then I'm going to actually start with you with some questions today. So if you'll tell us a little bit about yourself, Jason, please.
All right, great. Thanks, Wayne. I'm a tax partner with Frost PLLC. We are based here in Little Rock. Our headquarters are. We have offices in 4 other states and a nationwide reach. As I said on the last webinar I was on with the Venture Center, my world has been a PPP season along with tax season since March, and it continues to be that way. As Fred said, we were all jumping this morning to figure out what has changed and what's been added. The other benefit that we've had here at Frost, we have a wonderful team of professionals solely dedicated to following this legislation and keeping not only internally, but all of our clients informed. So we have a lot of great information at our website that's continually updated as well. So Wayne, Mimi, thank you for having us today, and we look forward to getting started.
You know, and it shouldn't go unrecognized for you all. You know, I like to use the expression that, you know, the banks have really been the ventilators for small business. And I think you guys have also played, obviously, a bedside role, if you will, to stay with that metaphor. And we're grateful to you all for, you know, making $1 billion worth of loans and working with your clients to help them survive during these quite remarkable times. So applause and thank you to you all for the extra effort, because I know many of you have gone without a lot of sleep much of the time. That being said, thank you all for your introduction. Let's jump into some questions. So I think the first question, which is probably could take an hour to answer, but I'm going to start with you, is what sort of major changes have occurred with the Flexibility Act as it relates to the application process, et cetera? Where are things today as it relates to the status of this program?
Are you asking me? I'm sorry, I didn't know. Okay. Right now we've got new application that just came out. That's a really big deal for our clients and for us to give us some guidance on what exactly SBA is looking for. So the new application that came out, there's actually two versions. There's the easy application, and then there's a new one that came out. I mean, there's a revised one, which is a little bit more document requirementation regarding employment status. But the forgiveness application is our driver. You know, this is what we can help clients help clients know what exactly they're going to need and help get those documents together. The one piece that we don't have as a bank, that is really important, is what do we do with this information and where does it go to? So that's what's been really difficult for us to guide our clients, because most clients are wanting guidance. They're fearful of how long this is going to take. When can I do this? And when can I do that? And it's really hard for us to provide that type of timeline, because we don't know once we receive this information. Like I said, today we just got the application. Once we receive this information, we don't know where to send it yet. It hasn't been disclosed or how it's going to be processed. Will SBA be the one reviewing? So there's a lot of unknowns up to this point of once we receive, how quickly will the forgiveness piece happen. The bank has up to 60 days, and then SBA has up to 90 days. So it could be a lengthy process. It could not be. I mean, if you look at the application, it looks like the certifications are pretty simple. So it could be a situation where they're processed pretty quickly. So it's just a situation that we're hopeful, with as many applications that are going to be submitted for forgiveness, that Congress will make sure that it doesn't get bogged down on the forgiveness side.
Good deal. I don't know, Fred, Cal, or Jason, if you want to add to that at all. Obviously, there's pretty significant. So, what are your thoughts on that?
Sorry, Wayne, you broke up just a little bit with your question. Can you repeat it?
Yeah, I think we're picking up some static. If you're on, please mute. My question was based on Itzel's comments about the collection of data and advising the clients and so forth, and what to do with that data. If any of you all have any comments around that same topic.
I mean, I think the prevailing thought from the start with us has been, more documentation, the better. The new application forms do provide some guidance as to documents that they are absolutely going to require, some suggested documentation that they would like you to have and keep for a period of time. But I'm not a lender, but I've taken more of a practical approach to this with my clients and advise them, think through what best documents, what has happened, even the mistakes that my clients have made in terms of maybe flowing some funds out of the PPP account for other purposes by mistake. And just being able to track that and being able to provide your lender like Itzel the best track and footprint for them to be able to award you with forgiveness or at least partial forgiveness.
And I would add on the documentation, not just expenses that you're making on payroll, but going back to the original certification of the need for the loan, and continue to especially for larger loans over 2 million that will be audited, and then there'll be a threshold below that that might get audited. But just back to the original certification of the need for the loan and what's happening to your particular industry and the businesses in your industry, I would continue to document that in case there's a look back on at the time of forgiveness. Cal?
No, I agree with that. A lot of people right now haven't seen a huge effect on their business. Some have. Obviously, hospitality, restaurants have been hit hard, and others. A lot of businesses haven't quite yet seen the drop. And you do have to make certifications whenever you apply for forgiveness. That the loan was necessary, and it's the uncertainty, it's the economic uncertainty that you really need to key on in making certifications. And so even if that downturn in business doesn't happen until Q3 or Q4, or ultimately doesn't happen, the more that you can document showing that there's an uncertainty around your industry or your business, there's competitors that are either shutting down or having to scale back. Those sort of things will certainly help in the long run. If you took out a loan above $2 million, we know that you're going to be audited by the SBA. So having things like that in the file to justify your need for the loan will really help.
Let's talk a little bit about the time period and also the extension of the forgiveness period and so forth. Not sure which one of you would like to sort of take that topic to begin with, but that's one of the things that, not only is the guidance changing, but the time frames around this seem to be shifting too a little bit. Can any of you speak to that with a little bit of authority? Because I certainly can't.
Well, I'll take a first shot at it, and you guys can add on. But as of last night and this morning, after the Flexibility Act was enacted on June 5th, they finally come out. They'd come out with 2 updates, one on the 12th and one on the 17th, which is this morning, that gave a little more color to some of the time frames and what they would look at. And we'll get into some of that in detail here in a minute. But the point is, when they adopted the Flexibility Act, I don't think they'd fully thought through the impact of the extension of the time periods from June 30 to December 31st. But they've done a little better job now as of this morning to give some color to that. So Cal or Itzel, Jason.
Yeah, I would just add that Congress has been listening to business owners, to bankers, just listening that most of our industries didn't really get an opportunity to hire their staff at the rate that they thought they could, mainly because of restrictions on opening up 100%. A lot of restaurants can't open at full capacity. Dentistries were really impacted as well because they couldn't open up at the level they thought they could. So I think after listening to everybody, and Congress did a good job of recognizing what they thought was going to be able to be spent within a very quick time frame was not realistic for most clients. So extending the time period to 24 weeks definitely helps clients have enough time to hire their employees, because that's the feedback I kept getting is I can't get my employees back. They were having conflicts with them wanting to stay unemployed because they were making more money being unemployed. And so this gives the business owner a lot more opportunity to either replace those employees or be in a situation where they can truly spend that money within a 24-week period, which is more realistic when they're not fully operational.
It was part of the.
I would say you can still elect to end the 8 week. You can still have your covered period as the 8 weeks after the loan origination, but the extension of 24 weeks, there was some uncertainty around what that really meant as far as the employees and the pay. But some of the guidance that came out this morning on the 24-week extension increased the maximum forgiveness cap per individual to $46,154. So that's based on 100,000 divided by 52 times 24. So,
and I think Itzel put it best in that, again, Congress came back around, made us a little bit more realistic to the situation. But what we also have to recognize is that we had a bipartisan effort to deploy significant amounts of money into the economy. Yeah, they thought it was going to be 8 weeks, and they were. As with this whole situation from the start, we've all had to adjust and adapt. So kudos to Congress for the 24-week extension, which is going to help a lot of people. I had a client of mine that was looking at electing the 8, called me this morning and said he needs 1 more week. So that in and of itself is showing the flexibility that's truly coming out of this latest guidance.
So how would you advise, I mean, obviously the extension is an option for people in business to consider. And it'd be interesting if maybe one of you, Jason, since you just talked about your client this morning, so how do you advise them to extend that? Is there an application for that purpose? To go from the 8?
As Fred said, 24-week is now standard. It's okay. If you want to stay within the 8 week, it's an election back. And I'm hearing more from people that are saying they want to stay. They had been gearing up towards the 8 week. They did the application process. They really worked towards that standard and want to stay within that 8 week period if it's at all possible. But
and something that may help that was one of the changes on payroll having to be 75%. Now it's reduced to 60%. So your qualified expenses can be up to 40% instead of the 25%.
So one of the other things with the Flexibility Act was the reduction to minimum required use of proceeds for payroll costs. So that is what you just spoke to. Is that it, Fred?
That's what I was referring to. Yes, and there was some uncertainty as to whether or not you had to spend 60%, and if it was a cliff if you didn't spend 60% if you got no loan forgiveness. But that's been clarified in the last few weeks that it's up to 60%. You can spend. You have to look at it in reverse. Really, it's up to 40% on non-payroll costs that are qualified expenses. But if you spent 55% on payroll, only 55%, you would still get forgiveness. It would just be partial non-forgiveness.
So one of the things that I think is sometimes confusing is, you talked a little bit earlier about the fact that, Itzel, you talked about people in the hospitality industry specifically. So if I own a restaurant, phase 1, I'm at 30% of capacity. Phase 2, I'm at 60% of capacity. And then whenever we see it. So obviously I don't have an environment that enables me to hire back all of those people, but yet I've taken a loan to support that for 100% payroll return of that staff. So in that circumstance, as the business owner, is it in my best interest, obviously, to basically keep that powder dry until those restrictions are lifted? Because obviously I'm borrowing based on 100% efficiency of my payroll, but yet I'm only putting 30% of that to work. So how do you advise people with that? Obviously you're going to be audited. You have an obligation to how that money is being used. But as long as that money sits dormant while that ramp up occurs, is that how you're advising people? I'm curious on that.
Yeah, that's exactly right. There's so many industries that have been going through these phases that can't ramp up fast enough. And I think that's exactly the reason why Congress gave up to 24 weeks, in that the hopes is that everything will start coming back and you have a lot more time frame to spend that money. If you think about how the loan was calculated, it was based off a 2.5 week period. But if you have now 24 weeks to spend that money, the probability of you spending it is a lot higher. Of course, if you shut down, that's going to be a completely different situation. But if you are still operational and maybe not at the full capacity, you still have the ability to spend at least 60% within a 24-week time period. So I think that's exactly why Congress said, how do we help these business owners that took out that loan and now are in a situation that because of their city or state or the industry itself, they can't open fully, they shouldn't be penalized. So we are advising our clients to take the 24-week period to truly use it for what the intent was for, and they shouldn't have a problem, you know, having it forgiven. I mean, the goal is not to have the client end up with debt after this. That's not the goal. I mean, the goal is to have this fully forgiven so that the client does not experience any financial hardship over it.
Gotcha. Good. Thank you very much. Fred, I'm going to direct this one at you. Extension of the safe harbor period for loan forgiveness. Can you speak about that a little bit and why that's important? You're muted.
Sorry about that.
You're good.
Sure. With the original act, you were required to have the same head count by June 30th. And there was a safe harbor in there for where you offered former employees reemployment and they declined. That was not going to count against you in the forgiveness. And we advised when that safe harbor came into place from a legal standpoint, a documentation standpoint, we advised clients to, and we had a one-page consent form that said, I accept reemployment or I decline reemployment, to document that, because we did have some cases where folks didn't want to come back to work because they were making more money with the extra $600 through July 31st than if they came back to work. So that may change after July 31 if the 600 drops off the map. But with the Flexibility Act, they extended the June 30 timeframe through December 31st. And it's, Cal can talk to this a little bit, but it's still a little unclear given the 24 weeks and December 31st, how that might work. But there was the safe harbor is now on or before December 31st, 2020. And for borrowers who can't return to the same level of quote business activity as the borrower was operating it before February 15th, due to compliance issued by various state and federal agencies during the period between March 31st and December 31st, 2020, you are given some credit against the forgiveness. Now, what business activity means was a little unclear also, but this morning's Itzel mentioned the easy application and the instructions for the easy application, and it gives a definition of unable to operate during the covered period and goes into a little more detail and throws out certain agencies from, you know, directives issued by the Secretary of Health and Human Services, Director of the Centers for Disease Control and Prevention, or the Occupational Health Administration, relating to the maintenance of standards of sanitation, social distancing, or any other work or customer safety requirement related to COVID. So there's a little more guidance on what impact on business activity means now. Cal, do you want to add to that?
I think you covered it pretty well.
Good there. The next item that seems to be related to the flexibility is the extension of payment deferral. Jason, can you speak to that?
Right. I think as with everything else we've seen in these recent changes, Congress just continues to give everybody a little bit more time to adjust. The deferral period under the prior rules have been 6 months. It's now been extended to 10 months, and that applies across the board, all loans that have been, regardless of when they were issued. I think it dates back to March 27th. So essentially, from the moment you submit your loan forgiveness application, you have a 10-month window in which you do not have to make payments of interest or principal. And obviously, as Itzel said, the goal is to receive 100% forgiveness, but in the case in the event you don't, and you have to repay some of this, you still have a 10-month period deferral before you have to start making payments. If you don't make an application for forgiveness during that 10-month period, then you have, you will start making interest and principal payments at the end of those 10 months. I do agree with what Itzel had to say. The goal of going through this process is to obtain forgiveness. As the thrust of today's discussion has been, Congress has continued to make it easier to get forgiveness, but don't forget that if you don't receive full forgiveness, that we're still talking about a 5-year loan at 1%, which is as advantageous as you can ask for in today's climate. So that's the other consideration to take into account, and not stress about, you know, obviously if you can't get forgiveness, at least the federal government in this program has been very lenient with the repayment terms and the interest rate in which applies to it.
And Jason, you raised an interesting question for Itzel, because the 5-year maturities on the new loans after June 4th, right? But for loans prior to that date, lenders and borrowers may mutually agree to extend the term to 5 years. So what's a bank going to be likely to do when a borrower approaches for a loan prior to June 5th and asks for a 5-year extension on a 1% note, when you've got to go change all your documents and et cetera, et cetera?
Yeah, and that's the most important point to bring out, because every bank is looking at this differently. So I will point out our point of view doesn't mean that it's the same point of view for every bank. Every institution has different sizes, different ways that they're looking at this money, and the option to, you know, extend it to 5 years. I'll just tell you, it just doesn't make any financial sense for a bank to want to stay out there that long, because we don't make enough money at 1%. So the goal is obviously to visit with the clients that aren't able to have it forgiven and try to figure out what, you know, works mutually best for the bank and for the client. So I would just point out that no matter who you got your PPP loan with, it's important to have those conversations early on and not assume the bank will automatically give you a 5-year extension, is what I'm trying to say. They may choose not to, and then you're faced with having to pay that back at a 2-year time frame. And that's very, you know, if you got a very large PPP loan, that can be a substantial difference. And so that's one thing that Congress did, you know, kind of put out there, that it's up to the lender and the client, but the reality is the client may want it and the lender may not. And so those are conversations you want to have early on, so you're not surprised if the bank chooses not to go back and revise your existing documents. And like I said, for us, we're basing everything on a case by case, but again, our big focus to all of our clients is to make sure they recognize they've got to get this forgiven, because debt that's incurred over this is not a good financial situation for their business at all.
And we sit in a unique position of dealing with a lot of our clients and advising them, and we represent some banks and have been advising them from a lending standpoint. And after June 5th, I've had a few of our bank clients just tell me they're not going to make any more new loans because they don't want a 5-year loan at 1%. Mm-hmm. So if you're getting a new loan at this point, you, just as we told everybody on the front end, it's all about, you know, get to your banker and have discussions with your banker and understand what their needs are and what they have to offer. So just don't assume your bank is going to make a new loan. If you're a customer of a certain bank, be sure and have a conversation with them.
Mm-hmm. And I think some of the conversations we had with some of the lenders that up front as well when this first started, no bank was interested in these loans or under these terms. And this really was, and I understand how the dynamic has changed somewhat since the crisis has moved on, but the real purpose of these loans was to help the customer out and to inject this money into the economy. So while I would agree, have that conversation with your bank, I do think a lot of the more community-sized banks and others understand the goal of this program and the value that it has brought So while the 5-year may not be near as attractive as a 2-year, the 2-year never was attractive to the banks on a profitability basis. So it'll be interesting to see how those conversations end up. And you're right, it will be a bank by bank basis and perhaps a banker by banker basis.
And I would also add that probably based on this morning's guidance and some of the easy applications and looking at the loan forgiveness, that those opinions may have changed since the initial Flexibility Act came out and extended the period 5 years. And I agree with Jason.
There's been some businesses that have taken advantage of this low cost interest for loans. So, and I'd be curious to know about, I guess, one, how are they going to look at this? How's the SBA going to look at this? But also, how does the bank look at this? So if I had a $50,000 note in my business, I was able to secure $50,000 through PPP. Some people are paying off those higher interest notes with the lower interest loan. Obviously, they still have the burden of proof. But have you seen any of this? I mean, I'm certainly aware of 1 or 2 businesses that have done that.
Well, I know I've been asked, but I don't know of any ones that have truly done it. I've been asked, could I do this? What would be the harm? And I go back to saying, be careful, because you've got certifications that you're making. So right now it seems like it's no big deal, but if for some reason, you are certifying that you're going to be using these funds for payroll and you turn around and use it to pay off debt and you did it purposely, you could possibly, and I'm not a lawyer, so I guess Cal and Fred can speak on this, but I would say they could possibly get penalized for fraud, and that would not be a good situation for them at all. For us as lenders, obviously, we're held harmless. The new application doesn't really give us a whole lot of guidance on how much we are liable on our end to verify certain items, but a lot of these clients don't give us a lot of information to know if they're doing the right thing or the wrong thing. So a lot of the truth or the documentation is having to come from the client. So they have to be very careful. If they're doing anything intentionally wrong, they could definitely look at some charges, in my opinion.
Lawyers, thoughts on that?
Cal, you've looked at this one quite a bit.
Yeah, and I absolutely agree with Itzel's comments there. Whenever you make the certifications for the application, you are required to certify that the loan proceeds are necessary to support your ongoing operations. There's other certifications that specifically relate to your use of the funds and those being used for eligible expenses like payroll, rent, mortgage, utilities. And so, I think that the SBA is likely to take an interpretation that if you took out this loan and didn't spend the money on any of those types of expenses, and instead you paid down debt, or you paid, you made some capital expenditures or did some things like that, I think that the SBA could very easily take the interpretation that those expenses were not necessary to support your ongoing operations. They're either, paying down debt isn't really an operational expense. Buying new capital equipment purchases or things like that are also not, and you have a little bit more of an argument there, but they still don't go to the heart of this program, which is to keep people employed, to keep people off unemployment. And so if you go with the purpose and intent and knowledge that you're going to apply for these loans and not use them on payroll and just use it as a 5-year 1% loan, I think you do have potential legal liability based on the certifications that you're required to make in the application.
With one of the interim rule guidance that came out, they did relax the fear around the criminal aspect of the initial certification, right, Cal? But I mean, still any willful act of knowingly going and taking the money and doing the things that you're not supposed to, I think they will make an example of someone early on in the forgiveness period and send a message to the world that they won't be tolerated, and you better make your certification, and at the time you make your certification for forgiveness, we're going to look at that too. So that's just a guess.
Yeah, I mean, there's already been a few examples of people who either falsified employees and or spend it in ways that weren't intended. They've already have made a few examples of that. But you're right. That initial certification is what everybody's been pointing to from day one, and they, for lack of a better word, scared enough people to return the money instead of going through that type of scrutiny, rather than employ the money to a good use. So. There's definitely that cloud that's going to be hanging over it, regardless of what direction you head.
I guess Cal and Fred, let me stick with you guys for a minute. We've talked a little bit about what are the legal implications of the Flexibility Act as it relates to some degree, bad actors here, as I just brought up, as it relates to this particular issue. But nobody wants to get in trouble. People want to do the right things. They want the forgiveness, et cetera. Here. Are there any particular legal minefields, potholes, areas that people need to be very conscientious about? I don't mean to ask you to dispense advice here, but I'm going to, I guess, indirectly or directly. But I mean, if you were advising me today in my business, and I owned a restaurant, anything in particular that you would say, hey, Wayne, really, you need to look out for these things, or just be conscientious about that? I think I've heard a lot of that, but
on the front end, we advised our clients to set up separate accounts to fully account for the money as it was spent. I know for a fact that probably half of our clients that I've looked at and talked to didn't do that. So tracking that money and keeping good records is going to be key. And I think, Jason, you referenced that earlier. So it's all about documentation, and it's documentation, like I said, from the front end on looking at the impact on your business and continuing to document that in your industry throughout the time until the loan is forgiven. I would continually document impacts on your business specifically and your industry. Keep those accounting records as clean as you can for the bank. I know Itzel will appreciate that when you come to her for forgiveness. And just remember everything in the certification on the front end, because that's where there's going to be some people get tripped up. But they've announced that they're going to audit $2 million and over loans, and I'm looking at the stats through June 14th, and they're out of almost 4 million loans. It looks like only 24,734 are over 2 million. So it's a 0.5% count of the total that will even be subject to that mandatory audit, but they'll audit some companies less than that.
And I think they're going to make some early examples too, for sure.
I do too.
Yeah, and from the legal side, from your liability, obviously, borrowers, there are certifications both in the application for the loan and in the forgiveness application that they are relatively easy to understand. They're at least verbatim on the page in front of you. You can read them, see them, and know what certifications you're making. The part where I think there's a lot more analysis that should be done that maybe a lot of people, especially early on, were not doing, is with the affiliation rules. The affiliation rules under the SBA regs are very complicated and very broad. So when you look at, is your business even eligible to receive a PPP loan, you're required to make that certification. You're required to say we are eligible, when aggregated with our affiliates, to apply for this loan. The problem is the loan application doesn't go into the affiliation rules. And, with the venture sitter, especially with startups, any startups who have received, venture money, private equity money, there are some complicated calculations and determinations that have to be made to figure out, are you an affiliate of your PE-backed company or investor? And then if you are affiliated with them, are you then affiliated with all of their other portfolio companies to the extent that You no longer meet the 500 employee threshold. You no longer meet the net asset or the net worth threshold to be eligible. And so a lot of people early on did not run the analysis of the affiliation rules, and the affiliation rules have changed a little bit throughout this process. And so if you have any major companies with a lot of employees that either own a majority of your company, have control of your board of directors, or if they even have approval rights under your governing documents, if they have the right to approve, a sale transaction or issuing new shares or taking out a loan or any of those things, you can be deemed to be affiliated with that company, and you're deemed to be affiliate with all of their other affiliates. So that's a certification that can really trip up a lot of people if they're not digging into it. For mom and pop shop restaurants and if your ownership is controlled in a relatively short few number of people, this probably isn't going to be a big deal. But if you have, like I said, if you have a PE company or any sort of venture investor in your portfolio of shareholders, affiliation rules create a lot of legal problems for borrowers.
I would go ahead, Wayne.
No, I'm curious just to kind of build on Cal's point there is, again, and Itzel, maybe you can help with that a little bit. Maybe I'm wrong to look for that, but how does one avoid that? That's pretty complicated stuff. That is very far-reaching when you get into the VC and the PE communities.
Absolutely. Now, I will tell you that's probably the most difficult answer for us because, our typical SBA guidelines were thrown out the window. We were providing loans to business owners that we never could provide SBA loans for, such as, nonprofits, churches, and their affiliations. So it was really hard for us to navigate through our affiliation rules because there were businesses that we don't typically handle that were being looped into possible affiliates and the way we look at businesses. And the other hard part for us as lenders is, again, we weren't given financial information on these businesses. It's not that we would know if they have affiliation with other companies unless they disclose it to us. And then we don't know to the level of how involved they are financially with them because the questions were so limiting that for us as lenders, it would be impossible for us to say, hey, we don't think you're eligible because of size standards, because we don't even have the financial records to be able to provide, we typically on SBA loans, we get tax returns, we get financial statements. So we have the ability to navigate that better. But in these situations, we were only provided payroll documentation. So we definitely kept telling the client, it's on you. You got to really know these rules and you got to really know what size you may be impacting. And when they didn't know, we had them, talk to their attorney, talk to their accountant to truly know. Some of them are small business owners and they were getting worried for no reason. But for some, if they were truly owned by a foreign company that's a private equity, well, we had one that pulled out because their board members didn't even know that one of them was applying for a PPP loan. And the board was like, we've got private equity or ownership and it's foreign. So they didn't want to even possibly run into an issue with that. So they pulled out of the PPP loan. So, that's where, again, it goes back to, even though we might have approved a PPP loan, the hold harmless is what we were leaning on because truly the client knows their situation much better than we do, especially if they're not clients of ours and they're not providing financial information.
And the regs explicitly state that it's not the bank's responsibility to determine affiliation rules, it's the borrower's. It's solely on the borrower's shoulders to determine affiliation determination.
That's probably where we spent as attorneys the most time with our clients on the front end was around those affiliation rules. And then when it came out about the larger companies getting loans and they turned back money, we had clients worried about the criminality, and then they addressed that. And other sources of capital, and that's an area that's really unclear still as to if you had a line of credit at the time you got your loan. Does that mean you should not have applied for a loan? And there's just no guidance on that yet. One thing that came out this morning that, go ahead, Jason. You have some. One thing that came out this morning that was very helpful was for self-employed independent contractors and sole proprietors. The loan was based on a 2.5 multiple, and the 8 weeks was 8 weeks. It was almost impossible to get full forgiveness for those folks. And so the guidance that came out this morning was that you could use either the 8 weeks, 8 of 52 of 2019 net profit up to $15,385 for an 8 week covered period, or 2.5 months worth, 2.5 divided by 12 of 2019 net profit up to $20,833 for a 24-week covered period, which should provide for full forgiveness for those folks that had $100,000 cap, and they got a full $20,833. So that was the best news I saw this morning for clarification on those folks. And then the easy loan forgiveness application, which Itzel mentioned as well.
Jason, did you have something you wanted to add to that? And if not, we'll get
in. I think Fred and Cal did a great job, and Cal to bring up the affiliation rules. It's really, as I said, it's the more complicated issue. I think the only comment I would make, Wayne, is that we've been dealing with this for months. There's been plenty of notice out to those who applied and those who received money. Several extended return the money if you had any questions, whether that was grant am I too big? You're not going to run afoul of any of these rules. So, I think as a unsophisticated or sophisticated business person, the amount of information that's been out there, the amount of information your advisors have been giving you or willing to provide, really did provide everybody with the ample opportunity to evaluate their situation and return the funds. Now, it's complicated, and Cal hit it on the nail on the head. It will continue to get there, and I think Itzel brought up the right approach of the banks. Although I did have a client who ignored the affiliation rules and said, well, my bank will pick up on this, and if my bank signs off, then I'm going to be good to go. They ended up applying, receiving an extremely large loan, and returning enough of the money to get them back around that $2 million point. So they had that opportunity. So we've seen that everybody's been very cognizant of try to address it the best they can.
Yeah. Thank you all. I want to jump on this last 10 minutes that we have here to share with you some of the questions that have come from the audience. The first one is it says, I'm still trying to discern if my sole member of our PLLC can claim payroll, or should this be left out? I think that speaks to the independent contractor rule, perhaps, and the sole proprietor issue. Do you want to address that, Fred?
Yeah, Cal and I may have to tag team this, but it depends on whether that individual is a W-2 employee, and it sounds like not, but partners in partnerships and members in LLCs could be included on the company application after some clarification in one of the guidance rules that came out. And I know of several folks that it was in the initial round that had partnerships, and they amended their application with their lender to include partner comp in the application, and it received the larger loan based on those partners and members in the LLC or partnership. Cal, you want to clarify that a little bit?
It's a complicated question, and one that's difficult to understand fully, because an owner in an LLC, could be a sole proprietorship disregarded entity. It could be a partner in a partnership. The LLC could have made an S corp election, and it could be a a shareholder of an S corp. There's just a lot of ins and outs of that question. And I think my best advice would be talk to an accountant, talk to a CPA or an attorney about your specific situation to see where you fall in, because it's different depending on the scenario.
I think generally the answer is most likely, just depends on the very specific fact pattern.
Well, I would think it backwards a little bit, because otherwise it could be perceived as a distribution, right?
Mm-hmm.
Could
I
be.
think the best thing for them to do is to go on the Treasury site, and it says how to calculate, and it'll tell you what exactly you need to provide the bank and how to calculate it based on if you filed as an S corp, a partnership, etc. So I would tell the client to go to the how to calculate tab that's in on the Treasury website, and that should give them some better guidance.
I'm going to move on to the next one, and so I think I'll direct this to you. Will a loan dispersed well before the June 5th date automatically have the 8-week period extended to 24 weeks? I think we addressed that in here, but would you mind addressing that again?
Yes, so the forgiveness application is what the client is going to have to be focusing on as far as if they're going to choose the 24-week alternative covered period or if they're going to choose the 8-week period. So on the application, I would recommend that they look at the forgiveness application to know exactly which one they're going to apply for, because just because they got their funds, we as a bank don't know if they're going to go 8 weeks or 24 weeks. It's the forgiveness application that gives us that information.
Gotcha. Thank you. Next question is, has there been any more direction on how the EIDL advance is handled? Is it added to your PPP loan and therefore forgivable as well if used for payroll? It's a pretty complicated question, actually. Do you want me to read it again, and I don't know which one?
Well, if it's talking about the $10,000 immediate grant when you made the EIDL loan application, that's offset against your PPP loan, and your EIDL is Itzel, you can correct me here, but EIDL is not to be used for payroll that your PPP loan was for. You can't double dip, in other words. And the uses for the EIDL loan are much broader. But those terms, I've had clients that did get the grant, got their loan app approved, and have turned down the $150,000 loan because of the personal guarantee, the pledge of the assets, the restrictions on the assets. So I've had more people not take the EIDL loan because of the loan document requirements in the loan documents that they didn't anticipate. That's all. Do you agree?
That's exactly right. So the EIDL is confusing a lot of customers because they're like, is that going to affect my forgiveness piece? And like you said, Fred, as long as they're not using it for the same purpose as the PPP, the EIDL is set to be apart from the PPP. It's to help them for, they do want to purchase new equipment or have more working capital for rent, utilities, etc. The things that the PPP loan cannot provide, that's more of a long-term loan. It's a 30-year loan at 3.75, and there are a lot more restrictions because it is a debt that's going to be in place. It's not going to be forgiven. So if the client believes that the payroll protection program, the PPP loan, is not going to be enough for them and they need more payroll, that's when we can refinance the EIDL loan into the PPP and provide that for payroll. But if not, they should be separating that out and using the EIDL for separate funds. And that's something that I've been asked a lot, like, what can I use it for? We are not, as a bank, we're not involved in the EIDL. There are certain things that you can use the EIDL for, but the one thing you cannot is to pay off existing debt. So that's something that I will point out, because a lot of clients want to use that money as well to pay off existing debt, and you're not supposed to do that.
Just a few minutes left. I encourage anyone who's on the event here today who would like to unmute themselves and ask a question directly. second to do that. And if you'd like to direct it towards any of the panelists, that would be fine. So let me just stop there for a second and see if anybody wants to make a direct question. Go ahead.
So I received about $50,000 in PPP funds on the 20th of April. And because I had 8 weeks to spend it, I spent it way more generously than I would have if had I known there was 24 weeks or that it would change. I'm just kind of wondering, is there any conversation around people in that boat? Because I know there's a lot out there. You know, I don't know what can be done, but I don't know. I guess I'm just kind of annoyed at the fact that they got changed, and now I have, you know, there's a lot of money that I could have spent better. You know, are they going to make any changes for people in that boat at all that you guys know of?
I would say no, you know, because they have not said that there can be additional, because that's a common question. Can I get another PPP loan? Can my existing PPP loan be increased? And that makes it really difficult for us as a lender because our reports have already been provided to SBA. As of now, you can only have one PPP loan. And so what I have told our lenders and clients is that if you're patient, there's more regulation that comes out. So be careful on what you do, kind of like the forgiveness piece. The faster you work or the faster you spend the money, it can come back to bite you. So be patient and don't do anything haphazardly. Wait until you get more information to make some judgment calls. So unfortunately, there may be a lot of clients like you that just spent it and wish that they had it back. But I don't know. As of now, there's not been any changes to change that situation.
I think his question really goes to what we heard a lot of clients saying when the 8-week period was there and the 75% payroll requirement was there was, you know, am I paying extra for, you know, hazard pay, COVID pay? Am I paying out some sort of bonus? And that's a recurring issue, and that people were rushing to try to meet that 8-week and 75% threshold now are caught to where, yeah, as he said, if he'd known about the 60% in 24 weeks, he may have taken a different path. But I think to answer your question is, rather than discussing, you know, can I get an increase in my PP, another loan or an increase? Yeah, there is no real guidance right now to say that you can readjust how you've spent your money and spread that out over time. So.
Good deal. Well, folks, we're about out of time. And thank you for your questions. And thanks to Cal, Fred, Itzel, and Jason for not only sharing your thoughts today, but also for the support that you all give us here at the Venture Center. Once again, we're very grateful to Wright, Lindsey, Jennings, who's been a great partner here, obviously Frost, and always the Chamber. Please stay tuned. You know, we are trying to do our very best here at the Venture Center to bring content to you all that is relevant, that is meaningful, that is useful. We have lots of smart people like the four of those who are with us today to help us convey this information. If there is certain things that you would like us to convey during this time, or things that you would like us to research and panels that you would like us to bring together, we are eager to do so and would like to. So please put your hand up to Mimi, myself, Ashley, Becky, Daniel, any of us that are part of the Venture Center or board. You know how to get in touch with us. In addition, if you'll look at the chat to the information as it relates to being able to connect directly with the folks who are on the panel today, their email addresses, phone numbers, et cetera, are there. So if you'd like to get some additional advice, it may have a little different cost than being on this, but we'll let you guys negotiate that directly with each of them. And I just want to once again always say thanks to my team who does such a great job of really bringing these issues to the forefront and finding out what's important to our community. We are here to serve you guys. It's a tough and unusual time. I hope you all are wearing your masks. I'm going to say that because, man, it doesn't seem like it's getting better. It seems like it's getting worse. So I'm glad to see people are trying to adopt this direction that people are giving us so we can get through this and get back to whatever our new normal will be. We thank you all and appreciate you all, and stay well, stay healthy, and go wash your hands. Have a great day.
Thank you.
Thank you all. That was good information. Very good.
Thanks, everyone.
Woo-hoo.